Welcome to Lecture 9 in this 10 lecture series which introduces economics to you. In America this would be called the Economics 101 course, the first university course you would take up to university in economics to introduce all the main points to you. The 10 lectures covered microeconomics, and we're now into macroeconomics with 2 lectures to go. As far as macroeconomics is concerned, if you're following the sequence of the lectures, you will understand now that you can measure an economy, but you have to be careful in the way that you measure it. You can understand that there are different theories, and I just introduced 2 very simplistic theories to you which explain why economists disagree about the level of intervention in the economy, and why there are some economists who want less intervention in the economy, like me, and there are some economists who want more intervention in the economy. We then identified the big economic problems, and we talked about those, the problems like inflation and the problems like unemployment. And we introduced the first of the macroeconomic policies, which is a demand management policy called monetary policy. And by definition, monetary policy is managing the aggregate level of monetary demand in the economy using 2 levers, the quantity of money and the price of money, all managed by your central bank, in our case the Bank of England. We're now going to look at the second of the demand management policies, which we can look at separately, and then I'll bring them together at the end, which is fiscal policy. And fiscal policy has almost the same definition. It's managing the overall level of aggregate demand in an economy, but it has 3 levers this time. We're using government spending, taxation and government borrowing. This all carried out directly by the government's Treasury. So when I've given this lecture before, the lecture has been titled Fiscal Policy. In theory it's great, in practice it's a total failure, and I'll take you through why I have moved from theory being great to practice being a failure. You have to go back to the Second World War. Before the Second World War, we were going through, as the world was going through, a depression, and the economist John Maynard Keynes was much concerned about recession, depression. How do you get out of this? He wrote his book, The General Theory of Employment, Interest and Money, where he introduced a new theory of how to manage an economy. A simple diagram, hopefully to see through what we are talking about here. And in this diagram we've got a horizontal axis which is just time, we've got a vertical axis which is pluses and minuses, and then we've got our trade cycle, which we've talked about before, or our economic cycle, or our fluctuations in economic activity, which tend to go up and down. That's the red line, and we'd have booms at the top and recessions and depressions at the bottom, and then we'd have recoveries back to boom. So without any intervention, the argument of some economists is that capitalism and free market economies naturally tend to be cyclical, to go up and down. Now, at the time that Keynes was observing this, what he was seeing was that the ups and downs were reinforced by government actions. When you're moving into a boom, employment increases, wages go up, tax revenues increase, and the government spends more. That pushes the boom upwards. As you move into depression, unemployment rises, incomes fall, tax revenues fall, and governments spend less. Keynes said, let's do the opposite of that. Why don't governments spend more when the economy is contracting and less when the economy is expanding? So he said this can all be done through fiscal policy, through the way the government uses their budget. So when the government finds itself in a situation where the economy is booming, then they need to remove some of the demand in the economy to stop it overheating, and they can budget for a surplus. They can take in more taxation than they spend, and that will sort of reduce the amplitude of the high point on this cycle. And then in times when we've got a depression, when government revenues are falling, then that's the time the governments want to spend more. They want to budget for a deficit during this time and increase demand in the economy to try and reduce the amplitude of this cycle, the red line, and bring it sort of closer to a straight line. Now, in theory, sounds great. And indeed, there were sort of hints that it worked in the 1960s. It was Keynesian counter-cyclical policy. It used deficits to close what we've referred to before as output gaps, and it used surpluses to stop the economy overheating. That had never happened before, so this was new economic management of the economy, all focused on Keynes theory and using fiscal policy. Now, if you actually go back and you looked at fiscal policy during the 1960s, it seemed to work reasonably well, but there was a little bit of what's called a stop-go cycle during this period of time, because every time the Keynesian economists wanted to push for some expansion in the economy, they tended to be constrained by the fact that we also were part of the gold exchange standard, and we had to keep our exchange rate fixed during this period of time. Now, what happens when you start to boost the economy and expand demand is quite often that you begin to suck in more imports, and you may redirect potential exports into the home market, and you end up with a current account deficit on your balance of payments. And that means the supply of your money increases relative to the demand for your money on foreign exchange markets, and naturally the market price, the foreign exchange rate, would fall. To stop that, you've got to stop this expansionary policy. So we tended to have a period of time when we fluctuated at a fairly high level of employment, and it looked as though Keynesian demand management policies could work, and could work better, but for the fixed exchange rate. So when we get into the 1970s, you see a situation where the economy, June 1971, was released from the fixed exchange rate system. Exchange rates were floating now, going up and down, and this is the time Keynesian economists said exactly what we need. We can now boost demand in the economy and ignore what happens to the exchange rate, because by boosting demand in the economy, we will promote employment, and we will move the economy towards full employment, and we will kickstart economic growth in the economy. Everything can now work as Keynes originally wanted. Unfortunately, it didn't work. The 70s didn't perform in the way that was expected. Now, one of the reasons I think this was the case was that in the 60s, the target for full employment was probably about 2.5% unemployment. That was not dissimilar to what was at that time the natural level of employment or unemployment in the economy, so it seemed achievable. However, when you go into the 70s, you've got powerful trade unions backed by law. It's probably the first time they've realised that the Trades Disputes Acts of 1907 and 14, a long time ago, actually worked in their favour. They had quite a lot of power here. There was a better welfare situation. There was more labour market inflexibility. And my suggestion at the time was that this raised the natural level of lowered the natural level of employment, raised the natural level of unemployment above 2.5%, perhaps to 3, perhaps to 4%. And the natural level is always the level that you will settle at, and trying to raise employment above that level didn't work. And it was an illustration that we explained last time about the Phillips curve not working. It doesn't work like that. And so what you had was boosts in demand, successive boosts in demand, that tended just to increase inflation during this period of time. There was an initial impact on employment, and there was a critical number in the early 70s, which was 1 million. 1 million is a good number that people can focus upon, and employment had risen just above 1 million when these policies started. The immediate effect was it dropped below 1 million again. The target was to try and get it down to around 700,000, 800,000 unemployment, but once the inflation started to pick up, then the unemployment very quickly rose back above 1 million. And for the 70s we had a period of time which would be described as stagflation. That is, you had employment high and you had inflation increasing as successive stimuli were added to the economy to try and achieve the inflation target. Not really the inflation target, so they didn't want to achieve some of the targets that were achieved for inflation. It was the employment and growth target. In fact, they had a target for growth. They wanted economic growth to be sustained throughout the 70s at 5% a year. Reality was we didn't even get up to 1% a year during that decade, illustrating the fact that these policies didn't work. Now, as we get towards the end of the 70s, a Prime Minister of the UK said this: "We used to think you could spend your way out of a recession and increase employment by cutting taxes and boosting government spending," the Keynesian position. "I tell you in all candour that this option no longer exists, and insofar as it ever did exist, it only worked on each occasion since the war by injecting a bigger dose of inflation into the economy, followed by a higher level of employment." Remember, during the 70s, inflation got up as high as just under 30% for one of those years. And 30% inflation, as you can imagine, is quite a high level. Now, when I ask people who said that, 9 out of 10 say, yes, Margaret Thatcher, it was the beginning of monetarism, wasn't it, and tight controls. And it was probably the beginning of monetarism as a test or an influence on the way that governments acted. But it was said by James Callaghan, who was the Labour Party Prime Minister at the time, and Dennis Healey, his Chancellor of the Exchequer. So they were well aware in the 70s of what went wrong, and it was following Keynesian demand management policies. As I said at the beginning, a great idea in theory, but in practice it just didn't seem to work. And we tended to forget about Keynesian economics and Keynesian demand management policies for a few decades, until we had the global financial crisis, 2007, 2008, when there was real signs of a depression, a deflation, rising unemployment, falling wages, and the G20 countries actually got together in the UK in April 2009, and they called upon all countries to go for a good Keynesian fiscal expansion, further demand management. Now, that fiscal policy was supported by a monetary policy which was initially a ZERPish type policy, zero interest rate policy. Not quite a zero interest rate, but bank rate fell from 5.75% very quickly down to 0.5%. And unfortunately, neither the fiscal policy or the low interest rates seemed to work, and that was then when we ended up introducing a quantitative easing program to buy up assets. You remember how that works. When you buy up assets, you actually put cash into the economy, and the attempt is to try and have that final increase in aggregate monetary demand that will solve all of our problems. It did actually cause inflation, that QE, to rise to just under 6%, and it didn't really do much else. So our, again, demand management policies weren't working through this period of time, and if we count back, hadn't worked for a long period of time. We now find ourselves facing a pandemic, and whether we like it or not, Keynesian demand management policies are back. This time they're backed by another group of economic thinkers who call themselves the modern monetary theorists. One of them, Stephanie Kelton, has written a book recently which explains why budget deficits are okay, and we can have really big budget deficits. There's no problem about the size of budget deficits. And so we've had further expansions through fiscal policy, really big budget deficits. I'll come to those a little later on in terms of the statistics. And we've had further monetary expansions. And this is going to have an effect on the economy. If the Keynesians are right, of course, it will boost employment, kickstart the economy, re-employ people and make us all better off. Or if economists like myself are right, then it's stagflation that's coming again. The very stagflation we had in the 60s will be back with us again in the early 20s of this century, probably starting in 2021. And again, the nice thing from your point of view is if you're watching this in 10 or 20 years' time, you can go, what an idiot, he was wrong, wasn't he? Or the other way around, you can say, yeah, he did get it right, didn't he? So we have got further fiscal boosts going on at this very moment to try and deal with the pandemic. So you can see fiscal policy, how it should work and how unfortunately it has been working. But at this point, let us just backtrack a little bit and try and understand the different theoretical approaches of those economists who want to intervene, that we're going to refer to as Keynesians or MMTers, and those economists like the monetarists and the Austrians who want less intervention in the economy. Now, if we're talking about the right and left in economics, the right and left in economics is quite clear. The left wants to use more national income spent by government, and the right wants to use less national income spent by government. I would be happy, and I'll explain why, for governments to be spending less than 25% of your national income, whereas currently the political parties, Labour, Lib Dems, Tories, they come in an area much further left of centre, where you're spending between 35 and 45% of national income, and you're a Tory if you're spending slightly less, and a Labour Party member if you're spending slightly more. But it doesn't really work like that, and governments, whether they're Labour, Lib Dems or Tories, are very much the same. There's a nice quotation which says it doesn't matter who you vote for, the government always gets in, and we do have, whichever government is there, ones that lean very much towards intervening in the economy. Now, all economists, so whether we want more intervention or less intervention, we want some government spending. So there's no doubt that governments have got to spend money. So we're not talking about economists who say we shouldn't have a government, or economists who say that government should take charge of 100% of resource allocation. We're talking about this more or less situation again. And Although I want less government spending, I recognise that some government spending is essential. I said this before, we need government spending on the public good, on public goods, those non-rival, non-excludable products that we all want, the collective consumption goods that we won't buy because we can't exclude other people from their use, things like law and order, internal defence, external defence, and in the classic case of street lighting. We all want those things paid for by a third party, which is usually national government or indeed local government. There's a little more debate over merit goods. You remember those merit goods are important goods which are under-consumed in the economy, and I highlighted two, which was the health service and education. And I'm quite happy to support health service and education. I quite like the idea of a national health service. Not all economists will agree with me on my side of the argument, and I would like state education. And I would like those to run as efficiently as possible, and they need to be financed. And so government spending, as far as I am concerned, could probably provide the public good and support the merit good with around 25% or less of the national income being spent by government. So there's no disagreement between economists that governments have got to do certain things in the economy. How do they finance those things? Well, I will argue at the end of this that they've got to finance them directly through taxation. So taxes are essential. Tax revenues are essential. There's also an argument that they can overspend their budget, particularly if you're a Keynesian, during periods of time when you need to budget for a deficit. So there is then a borrowing requirement necessary. Now, there are temporary borrowing requirements and permanent borrowing requirements. Temporary ones just happen through the year when there's a mismatch between government spending and taxation. Taxation comes in different rates at different times of the year. Government spending is fairly consistent throughout the whole year. So there are times when temporarily governments are short of money, and they will issue treasury bills, usually 90-day loans to government, and they're repaid after 90 days. So treasury bills sort of cover the mismatches during the year, and at the end of the year are wiped off the calculations. And if that is the case, you wouldn't have any permanent borrowing. However, if you're going to pursue Keynesian policies, you also need permanent borrowing to achieve your targets, and permanent borrowing will be financed by the government selling gilts, selling bonds with 5, 10, 15, 20 years to maturity, and indeed undated stock has been sold which has no date at all to be repaid. Now, all of those borrowing requirements, if they're permanent each year, add together and produce the national debt. And the national debt is something that is ignored by some economists. It's not important. By other economists, exactly the same. It is considered to be very important. So there are years when more borrowing will be necessary. There are exceptional years. There are unwanted events. There are wars. There are pandemics. All of these things will require some overspending and some borrowing. In unexceptional years, I would argue that this is not the case. However, in unexceptional years, you've still got your Keynesian demand management counter-cyclical policies, which will need financing. So the deficits, if you think about them, should be thought through in terms of, are they temporary, in which case they're cleared by the end of every year or every few years, or are they permanent? Are they going to become part of the national debt? Now, pursuing Keynesian demand management policies creates, in theory, budget deficits some years, budget surpluses other years. Now, there is a big political problem here, because it is easy to sell a budget deficit to politicians, because you're going to tell them you can spend more money and you can cut taxes. A double whammy for a politician. There are votes in spending more money, there are votes in cutting taxes. So I'm very much in favour of budget deficits. Budget surpluses, however, are a little bit more of a problem, because budget surpluses require the government to cut their expenditure and raise taxes. None of those things are particularly, or will make a government particularly popular with the voter if we're cutting expenditures and we are raising taxes. Now, if you were following Keynesian policies directly, and you were going from a year when you have a budget surplus because of strong boom conditions to deficit when you have recession and depression, if you're pursuing that policy, then you would expect that over a 50-year period you'd have a 50-50 split between deficits and surpluses. You'd have 25 deficits, 25 surpluses, not quite that precise, but you know what I mean. You'd have a roughly equal number of surpluses and deficits. However, if you look over the last 50 years, you will actually see that there have been 48 deficits and 2 surpluses between 1970 and 2020. So you ask yourself, why is that the case? Well, I've already said to you, it's easy to sell a deficit to a politician. It's not so easy to sell a surplus. So what's tended to happen is that Keynesian economists have morphed into new Keynesian economists, neo-Keynesian economists, and other theories which are just like Keynesian economics, which have tended to lead government into the fact that you can run bigger deficits when you want to get rid of recessions and depression, and then during other years you may run smaller deficits, but the idea is that you don't have to run surpluses. It's really bigger deficits and smaller deficits, because that's what politicians want to hear. They don't want to hear that they've got to cut expenditure and raise taxes. So you can see that there's a political angle here is likely to push government to employ economists who will persuade them that deficit spending is important and discourage them from going down the route of surplus spending. Now, that does mean that we have had a growing national debt every year, more or less since the Second World War. This growing national debt has been slowly growing year after year because of the permanent deficits that there are on yearly borrowing requirements. Now, it's interesting to look at the policies that I've described and what has happened to the national debt since 2008. In 2008, the national debt was just a little over £500 billion. It was about £580 billion. And then if you just look at 4-year periods up to 2020, it's now likely by the end of this year to be about £2.5 trillion. That is, it has grown fivefold over a 12-year period. So there are economists who tell you no problem at all. Well, I'll explain some of the reasons why they say this, but it is. It is a real problem having a national debt growing at this rate, and it's accelerated over the last 12 years out of all previous measures. It's a really big increase if we go to a national debt this year of £2.5 trillion. Think how many noughts there are in a trillion, and you might understand why this is potentially a problem. It's a problem because you've got to service that debt. There are interest charges that you have to pay on that debt, and those interest charges would be probably they'll fall this year between about £55 billion and £60 billion. We are in a situation where £895 billion worth of national debt has been bought back, and it's been bought back by the Bank of England, and the Bank of England, it's actually slightly more than that because the Bank of England maintains the same level of asset purchases, so when they mature it actually buys more, so they've actually bought more than that, but the total value of bought as opposed to matured second-hand debt held by the Bank of England is currently £895 billion. Now, one way, there are economists out there who say, well, that means the national debt has shrunk, doesn't it, by £895 billion. It hasn't actually shrunk. Technically, the taxpayer has been relieved of this debt. But it is those people who suffer the inflation, that printing money against this debt, it's those people who will actually be repaying the national debt, those people who see the value of their money, the value of their savings fall during the current period of time. So the national debt firstly has to be serviced. It's one of the reasons why interest rates are as low as they are, because a lot of money has to be spent on servicing the debt, with bank rate at 0.1% at the moment. Think how much money would have to be paid if further money was raised with bank rate back at, say, 5%. It's almost a frightening thought, that, isn't it? Now, in the past, governments have thought that a satisfactory debt to GDP ratio in this country, again another Labour politician, in this case it was Gordon Brown, who said that a 40% ratio of national debt to GDP was a maximum that we should maintain. The European Union, they actually said 60% should be the maximum situation that we find ourselves in. We're currently over 100% of GDP, so national debt to GDP ratio is more than 100% and growing. So again, that should ring alarm bells and cause people to worry just a little bit about things, because what it means now is that the yearly interest charges are greater than the defence budget. If interest rates start to go up and borrowing increases to accelerate, then you can quite easily see the borrowing requirement, national debt, interest rate charges exceeding the education budget, and so it goes on. So we're talking about a very big number here, and we're talking about a number that has led to some misunderstanding over the last 12 years about what austerity is. There has been no austerity at all in the UK economy. Government spending has rapidly accelerated during this period. So governments have been spending more and more money. Now, that's not austerity when governments spend more and more money. So why is it called austerity? It's called austerity because the amount of debt that has to be serviced has required quite a lot of government spending to service the debt. And the governments have actually started to make, or they did just before now, and the pandemic, started to make cuts in other real areas of government spending to pay for the interest charges on the national debt, so that there were areas who were feeling the pinch. There were cutbacks, and those were the people who were saying, we're going through a period of austerity, because they could see cutbacks in education and cutbacks in health. To them it was austerity, but there was no austerity in terms of government actions, because government actions were still accelerating the amount of money they spend. So, as far as I'm concerned, your austerity didn't exist It was just the way that we were mismanaging government finances that gave some people the impression that we were going through a period of austerity. So it does also make it a little bit of a problem when we talk about we need to get out of this austerity by spending more money, because government spending more money got us into this description of austerity that you want to get out of by spending even more money. You can see that there are problems there. So why, over the last 50 years, have these numbers escalated? These numbers have escalated and accelerated underlyingly because of Keynesian economics, because of the idea that you can stimulate the economy, you can increase demand in the economy, and it will boost growth and employment. So that's an underlying theoretical bedrock to the idea of bigger and bigger national debts and bigger yearly borrowing requirements. We had the G20 meeting in 2009 which said it's okay to do this, do as much as you like, and we had a further worrying restatement of this in 2014 that, please go for it. You also have in democracies an impending election is almost around the corner, at least a couple of years after a party gets in power, and impending elections mean let's spend more money, let's cut taxes. We don't really want to be doing something that might harm our chances of getting voted in at the next election. And you've had, of course, your global economic crisis now, your pandemic crisis, where you are in a position to be spending a lot more money as a government at a time when less revenues are coming in because we have our unemployment rising through the policies that have been pursued to stop the economy moving as fast as it would otherwise have moved. So we have these problems now which are just like fiscal demand management policies, expanding government spending and taxes falling, and support from our monetary policy, as Andrew Bailey, the Governor of the Bank of England, has said we will do what's necessary. If that means getting interest rates even into negative territory, we may do that. And of course, we're always here to print money and buy back government debt, which they are doing to a very large and unprecedented extent at the moment. Now, there are links between fiscal and monetary policy. I've talked about them 2 separate lectures, and they can be clearly separated. So this is a monetary policy, this is a fiscal policy. We've even had years where they didn't even support each other. We've had fiscal policies where the economy was being pushed to expand, and we've had monetary policies which have been very high interest rates, encouraging the demand not to expand. So we can separate them theoretically in our mind, but there are significant links between fiscal and monetary policy, and the best way to understand that is to understand the way that government finances deficits, yearly deficits. Its borrowing requirement for a year has 2 ways of being financed. You can borrow it from real people. You can borrow the money from you and me. Our pension funds, even ourselves, if we're very rich, can go out and buy lots of government debt because we consider it to be a safe form of borrowing. And borrowing from real people transfers spending power. It redistributes the same amount of spending power. In other words, if I buy some government bonds, then I can't spend that money now. I bought an asset with that money, but the government borrows it and it can spend that money now. So it's what would be called non-inflationary financing of debt. That's one way you can finance debt. The second way you can finance debt is to monetize it. Now, what that means is the debt, if it's just a yearly number, so this year's public sector borrowing requirement is, shall we say, £100 billion. On the markets, we may be able to sell £70 billion during the year, and £30 billion may be left unsold. The money's still spent by the government, but the debt is left unsold at the Bank of England, and the Bank of England will have to honour the government spending that has taken place, and it will print the money required. So that's monetising the debt. Quantitative easing as a policy is also monetising the debt. And the monetising of debt by the Bank of England over recent years means the Bank of England now owns 40% of the national debt. 40% of the national debt has been monetised. So you can see here straight away that fiscal policy has led to increasing the quantity of money. Fiscal policy increasing the quantity of money means fiscal policy is influencing and changing monetary policy. Your monetary policy causes inflation. And strangely enough, your inflation actually increases the tax take. So taxation can rise during periods of inflation. So the monetary policy that causes inflation raises tax. So you see you're in a situation where your fiscal policy can influence what monetary policy you're pursuing, and the other way around, your monetary policy can actually influence the amount of revenue that you get in as a government, and indeed your monetary policy, if it causes inflation, actually changes the real size of the national debt. The national debt is reduced when inflation is high, and the national debt is not reduced when inflation, or reduced less when inflation is low. Now, one of the really big issues about the national debt is, when we're talking about is it a problem or not, is are we shifting this to the next generation? And many economists will tell you no, and they'll tell you no because you don't want to hear that, or the next generation certainly don't want to hear that we're shifting debt that they will have to pay off. And various arguments are used to explain why this is not a problem. One that used to be around, I haven't heard it for a long time now, was governments saying that, look, if we borrow money now, we'll spend it so wisely and the economy will grow so quickly that you will be so much better off in the future that you won't mind paying a little towards the debt that we are building up now to do all these wonderful things. Of course, in the future, you will notice it, and you will not be all that happy if the economy hasn't grown and you have to pay off this debt. And I'm quite happy to have argued in other places that all government spending is paid for by taxation. It's either the taxpayer who pays it off now, or it's the future taxpayer who is going to pay it off. And the only way that you can avoid the future generation paying for the excess spending of the previous generation is if you can cause inflation. So if you start to buy back the debt very quickly after you've caused that debt problem, then you will find that the debt will be paid off by inflation. Those people who are damaged by inflation will be paying off the debt. So at the moment, the people who will be paying off debt are the savers, who are not getting a market rate of interest for their savings, so their savings are going down every year. And indeed, as we said on the last lecture, everyone who has cash contracts for money, they will be the people who will be paying off the debt. So the debt that we've built up, and the £2.5 trillion will create a burden for the next generation. How big that burden is will depend upon how much inflation we cause to reduce the real value of that debt. But in the future, there are people who will have to pay off that debt, and that debt may be paid off by issuing more debt. And economists might describe it kicking the can down the road. But at some point in the future, standards of living will be reduced to pay for the excess spending of this generation. But don't take my word for it, because there are plenty of economists who disagree with me. So read around this, when you're trying to make up your own mind about whether I've got this one right or not. So there are questions to deal with here. Does a budget deficit actually increase aggregate monetary demand? Well, if we financed all of that deficit by selling debt to real people, no, it doesn't. It just redistributes that demand. I can't spend, you can spend. It's sometimes referred to as crowding out the private sector by increasing things in the public sector. So there's no overall increase in aggregate demand, it's just a redistributive thing. If some of that debt is monetised, then yes, that does expand aggregate monetary demand by the amount of monetised debt. Does this have real effects in the economy? Well, if you're a Keynesian, of course it does, because this boost to aggregate monetary demand closes output gaps, raises employment, kickstarts the economy and gets everything growing. Or no, if like me you believe in natural levels of employment and unemployment and vertical aggregate supply curves which you cannot influence by manipulating demand. So obviously a big debate about that. Does the budget deficit increase employment and growth? Yes, again, in theory. I've just explained to you how Keynes said it will do that, and if Keynes was right, it would do that. But if you look at the evidence of the 1970s and the period from 2008 to the present day, you can see, no, it hasn't worked. I mean, it should have worked. We should have had more employment. We should have had accelerating economic growth, but we haven't had those things. And the best example of it not working is the 70s, because now there's a real excuse, isn't there? The pandemic is causing problems. In the 70s, there was that excuse about oil price rises, wasn't there? But the 70s is a really good example of the fact that budget deficits don't work in practice. They can only work in theory. So, ever larger budget deficits, accumulated national debt growing, means you've got a problem around the corner. Often these problems just need triggers. Is COVID-19 the trigger? Is this going to be something that is going to dramatically cause problems because government spending has accelerated rapidly, tax revenues are falling, borrowing is being financed by printed money? All of those things add together to a scenario equal to the 70s. You've got stagflation. Next year and the year after, inflation is going to start to pick up and unemployment is going to be high. So the very situation that we faced in the 70s, I believe, will be faced again in the not too distant future. So what you've got now is inflation picking up, unemployment rising, and a world economy that's pursuing very similar policies, so a weakening world economy and a weakening national economy. So not very good news. Now, I've explained to you how fiscal policy should work. I've also explained to you that I'm actually not a fan of fiscal policy at all. So let me say a few things about what I think should happen now. And that is, we have budgetary policies. Of course, we have budgetary policies because every year we want to know what the government's spending its money on and whether it's got to increase this or increase that and where they're going to get their money from. So I'm quite happy for there to be year-on-year balanced budgets. I recognise the fact it's difficult to persuade governments to balance their budgets because they don't see votes, do they? In balanced budgets, they want to spend more and cut taxes, so they see votes in budget deficit. So it may be something we need to impose on government by law and say that they must balance their budget over a 3-year term, perhaps until the national debt to GDP ratio falls below 30%. I could see some scope for allowing government borrowing then, but that will take decades, if not centuries, to achieve. So I don't want fiscal policy. I want budgetary policy to manage the provision of the public good and the merit good, but I don't want fiscal policy to exist. I don't want to manage the overall level of aggregate monetary demand in the economy. So I would really only have one demand management policy left, and that demand management policy would be monetary policy. And I've already said that monetary policy is fairly benign, doesn't do any good, but it can certainly do a lot of damage if it's not managed properly. So I will just give the Bank of England their inflation target of 2%, which they can hit because they can manage monetary policy, but I would make it a little bit more difficult for them. I'd say you can't manipulate interest rates to do it, so all you can do is manipulate the quantity of money to achieve your inflation target. So really, my demand management policies have disappeared as they have existed in previous years, and I would have no fiscal policy at all, and I would have monetary policy as being something which was just designed to maintain inflation at the target of 2%. And I explained why in the last lecture that you need that target. Now, because this is an argumentative area, a debating area, I do want you to think of what other people say. And I haven't been able to explain fully what I mean by the things that I've said. And if you do go to my blog, which is jbhearn.wordpress.com, then there are lots of articles just to support this. There's an article called A Fiscal Stimulus ? Do we need a fiscal stimulus? In other words, I'll explain why I think the answer is no. Over the last 20 years, have we had austerity or profligacy in government spending? Well, we've had no austerity. So yes, we've had profligacy. There's an article that explains that. There's an article entitled, Are Demand Management Policies a Solution, or are they just a mass delusion? I think they are a mass delusion. There's an article that says a balanced budget good by fiscal policy, which is exactly what I think should be the case when it comes to fiscal policy. There's another article of what really happened in the 70s, which some of it I've alluded to as I've been speaking to you today. And there is one particular tax that I would like to introduce, and I haven't been able to talk about individual taxes, but that's called reverse income tax, or as Milton Friedman said, negative income tax. So there's an article in there called Imagine that there was a reverse income tax. The only reason it's Imagine is that I was in Cuba with my family at Christmas, and there was a bench upon which John Lennon sat, and there's a model of John Lennon sitting on this bench, and we all sat around him, hence why Imagine is in that title. And then I've hinted, I haven't said much about modern monetary theory because it's fairly new, and hopefully it won't be taken too importantly, but I do worry. And there are actually 4 articles there which explain 4 big modern monetary theorists' mistakes. So they're quite easy to find. Mistake 1, mistake 2, mistake 3, and mistake 4. So I hope you've enjoyed the introduction to fiscal policy, both an introduction to how it should work and an introduction to the debates that there are around why I think it doesn't work. And it's no good repeating and repeating and repeating this because it doesn't work. But do listen to the other economists who will explain to you why it does work. Next lecture will be the last lecture in this series, where we will take our macroeconomics out to an international scale. So we will look at international trade and why international trade is important. So I look forward to speaking to you again when I have completed lecture 10. Thank you.